markets means at least a couple things, and we'll drill down a little bit into this as well. But on the one hand, it has to do with passive versus active investing, index funds versus stock pickers, if you will. It also has to do with high frequency trading and algorithms. And maybe the common denominator behind all of this is technology. Because if there wasn't technology, we wouldn't be having this conversation. It would still be people, guys with pieces of paper, and it was all guys back then, writing things down and placing orders. And for better or for worse, I'm old enough to remember those days back on the exchanges. But to my right, Adina runs an exchange that has been at the very fore of technology. The NASDAQ was fintech before fintech was cool, right?
Yeah.
I think that's the way to look at it. So, Adina, why don't I start off by asking you just sort of what your idea of automated markets is and what that means. Very kind of open-ended question. Just get some top-line thoughts.
Sure. Well, I do think we have to start by saying that the markets have been and will always be a combination of humans and machines. And I think that decision-making around investment decisions, whether they're long-term or short-term, will still culminate and start with the person making a fundamental choice. Now, it could be a technical choice. It could be a fundamental decision around the future of earnings of a company. It could be a strategy that they're undertaking in terms of delivering an outcome. And even if they are therefore then turning it into an index or turning it into an algorithm, there is still a human at the beginning of all of those decision chains. And so I'm a believer that anytime that the markets will swing too far towards automation, first of all, I think humans will have the opportunity to come in and arbitrage that with their judgment and with their wisdom. And with their strategies and other things. But I also believe that technology, as you said, is this kind of inevitability that's come into the market. It's democratized markets over time, so millions of investors have much better access to markets than they ever did before. They also have better access to information, better access to strategies, better access to investment vehicles, much more choice, and it's a lot cheaper for them to trade and to invest. However, you then also get a level of complexity that comes with technology as well. So I think that's part of the mystery that you mentioned, that the fact that you have all these different elements to the markets today, whether it's index investing, active investing, alternative investing, algorithmic investing, all of this culminating in the markets through technology, I think makes it so that it's harder for an investor to kind of understand the whole, but it's important for them to do it, but they should also always recognize that there are humans in that chain throughout the markets today.
Nice to hear that humans still matter.
Absolutely.
Right? David, let me switch over to you and ask you about your particular institution. And, big bank in Canada. Largest bank, right? Let's use the superlative when we can. Right? Okay, good. Forgive me. And I want to ask you, how does this debate or tension, if you will, impact your business? And what part of your business would this relate to even?
There's when you think about the topic that we're discussing today, there's the electronic side of things, and then there's the liquidity, volatility aspect of markets around passive and active. We're invested heavily in algorithms and algo trading and trying to execute for our clients in the best way possible. We launched a product called Aiden that focuses on block trading to help our asset management clients and our large funds trade effectively and get the best execution. So certainly AI is helping execute, helping manage the complexity in markets, and we've invested in that. I think one of the other distortions that we're seeing is liquidity. So when you have the amount of flow that you see into passive funds, you've got intraday liquidity challenges. 25% of the trading occurs at the closing auction. And that is the rebalancing that you see in passive funds. So intraday liquidity has certainly changed. And then what we saw over December was certainly a liquidity challenge in a number of issuers. We saw so many clients come into us for liquidity to take positions and we see that as a function of a lot of float going into passive and trading that we had to supply liquidity that we hadn't seen before. So there's a liquidity distortion that's happening on the passive active side. Is another dimension to this whole challenge.
I want to ask you about being able to oversee your oversight and being able to understand all this stuff, because this is not directly related, but say J.P. Morgan and Jamie Dimon, who I think is a terrific banker and a really smart guy, but even he didn't see the London that's not an active passive thing, but it sort of speaks to perhaps hidden parts of the bank and very complex strategies. How do you, as the chief executive, make sure that you understand everything that's going on like that?
Well, you rely on your team, but certainly it'll be a part of the governance of any organization, from the board through the management team. You set up a governance structure that allows you to sit down with your chief risk officer, with your head of capital markets, with the trading side of capital markets, or the investment side of capital markets. And when you do business reviews and you triangulate as a CEO, it's always hard to get it from one source. So as a CEO, you're constantly triangulating across your organization, outside your organization, trying to paint a picture. So for me, that comes through regular business reviews from functions through to businesses, and then certainly interacting outside the organization. You pick up the themes. One of the reasons you're here at Davos is to pick up some of these themes, bring it back to your organization, and challenge your organization. So every CEO has to set up that structure to triangulate on key issues.
I'm realizing that Bill and Ron on the outsides are the two longer-term investors. I don't know if we did that on purpose or not, to keep them away from the center, the too much activity. Ron, let me go over to you. I mean, as a longer-term investor, real estate and those sorts of securities, if you will, or investments, I should say. How does this debate even affect what you do for a living?
Well, we do take the long haul. We have to. We have about $190 billion that we invest around the world in real estate, private equity, public equity, all public markets. And so from our perspective, what we find is technology is the common link through all of this. And technology and what is happening to technology these days will only further leverage what is taking place. But from the trading floor, where we utilize algorithms for trading, all the way through to the companies that we own directly, we're using technology, we're using AI to drive ultimately better decisions. And we're using it in real estate. We're using it actually in real estate, for example, in our shopping malls, where we have to ultimately understand the customer better, what their needs are. And so to us, it's really about managing the technology and managing the risks of technology. And it's even raising some very important questions as a fiduciary for us. In the public trading area, for example, when we're using algorithms more and more, the so-called black box stuff, we're starting to get questions where people say, how can you actually fulfill your fiduciary duties by turning it over to a black box of some kind? How do you know that in these algorithms, that some of them being self-learning, how do you actually know that you can do something with it? Because once upon a day, if you measured PE and moving averages, you could actually figure out why you invested and why you followed something. And so this technology story, its complexity, is not an insignificant issue that CEOs all have to deal with. And for us, when it comes to the fiduciary side, we have to be very, very mindful that we can't push it so far that we turn our brains over. And I think Adina's points are bang on. There's always a human process at the very beginning of this. There has to be. Judgment has to ultimately be exercised in all of this. The machines and the language and the decision rules and the algorithms are nothing more than something that is repeatable over time. It's repeatable, and what we end up doing is putting our trust in the very things that create those decisions, and that they are repeatable, and that they do add value somewhere along the way. And of course, we're utilizing them in terms of efficiency, cost reduction, opportunity sets, making our companies better, understanding arbitrage opportunities that are hard to find just by doing a bit of math on the back of an envelope. So for us, it's everywhere, and we really have to, I think the biggest challenge for us is making sure that we are fulfilling our fiduciary duty, leveraging it, and really leveraging the deep insights that it's capable of bringing. And that's what, frankly, we're all really after, I think.
Right.
And I would say, I agree with everything you just said. We've actually invested in a great Canadian company based in Toronto.
All Canada today.
It is called Quandl, which is an alternative data provider. So it basically does allow for We basically work with our issuer clients and other organizations to find information that could be useful and informative to you and your strategies that you're implementing, to help you look at some level of predictive capabilities, to help you understand and get deeper insights into company performance or industry performance or trends that are what might impact certain industries or companies over time, or asset classes, including real estate and commodities. So, and that's something that we believe at the end of the day, again, it's a matter of making better decisions, but always understanding the underlying math. I mean, it is so important that we never let go of that underlying math as us understanding how it's impacting and how the outcome has been generated. But allowing the algorithm to coupled with the data, coupled with your knowledge, to make it so that you can make smarter investment decisions.
It's interesting how the conversation has sort of shifted a bit to risk management, right? Which I think is very much at the core of this. And Bill, I want to go over and talk to you and ask you a little bit and pick your brain. And you're a private equity guy. And a nice guy, according to Adina. That's what she told
You're
me.
welcome.
Good sticking it.
Yeah, right, yeah. But you also have a window into this world more directly because you're on the board of BlackRock. Yep. And I know BlackRock has also products and services that speak to this risk management when it comes to algorithms and such. So I'm wondering what your take on passive versus active and its impact on legacy institutions, for instance.
Oh, great, but thanks, Andy. I think there's sort of two mega trends taking hold right now and have been working for the past decade or so, will continue, which is the move towards passive investing. In the U.S. equity market, 10 years ago, it was about 9% passive. It's about 44% passive today, roughly. Anita may have some other data on that too, but it's a big shift in that way. And the big loser is public active management. And related to that, a lot of the active management shifted to the private markets. So you've had a real pickup in private